Hey everyone, IDFC First has declared its Q4 result and as expected, it was again a weak quarter for the bank with net profit falling 58% year on year. Although it is not a surprise because management had already indicated that Q4 would be bad. And the biggest reason is the exposure of IDFC First in microfinance segment that witnessed high slippages in FY25. Management has clarified that microfinance challenges are getting over and FY26 should witness strong recovery. Now, if you look at IDFC First stock price, it nearly tanked 50% from highs of 100 rupee in September 23 and made a bottom of around 52 rupee in March 25. During this phase, bank's valuation fell down from highs of price to book of 2.5 to levels of 1 and even below the median price to book of 1.5. Since then, stock has been recovering and the reason is stock market is always forward looking. It has already discounted the worst and bank's valuation touched price to book of 1. And now market would factor in FY26 performance. Now I've been tracking this bank for a long time, mainly due to leadership of Mr. Vaidyanathan. And bank has gone through a roller coaster journey since merger of IDFC with Capital First in 2018 to form IDFC First. Initial few years were challenging due to bank's high exposure in infrastructure loan that it inherited from IDFC Limited. On top of this, 2020 witnessed COVID. As a result, IDFC First reported very high NPA and losses in earning. However, since the merger in 2018, bank is focused on reducing this infrastructure loan and building a retail franchisee and has actually managed to build a good retail franchise. But the pain for IDFC First did not seem to get over. After showing a good performance in 2023 and 2024, this time it witnessed a problem in microfinance segment that resulted in sharp decline in FY25 earnings. Actually, if you look at bank's performance since 2018, its deposits have grown at fantastic 37% CAGR rate, where retail deposits have grown at crazy 63% CAGR rate, and advances have more than doubled from 2018 level. That too with significant reduction in infrastructure loans. But in banking sector, you can't really focus on growth. Certainly, deposit growth is not easy, and bank has done a fantastic job in building a solid deposit base. But while building the loan book, it is very important to have a solid credit underwriting process to ensure that the bank gives loan to right customer so that it does not default in case of any challenges in the industry. And IDFC First has faced this problem initially with infrastructure loan and now with microfinance exposure. Also recently, bank has raised around 7,500 crore by diluting the equity. And this is not the first time IDFC First has diluted its equity to raise fund. In fact, it has been diluting its equity multiple times in the last few years. And that's where I want to discuss why IDFC First is consistently diluting its equity and why it is important for shareholders to keep a close eye on this development. So IDFC First board has approved raising 7,500 crores of fund from Warburg Pincus and Abu Dhabi Investment Authority. It is a preferential allotment at a price of Rs 60. The idea behind this fundraise is to expand the loan book, strengthen capital adequacy, improve ROA, that is return on asset, and boost return on equity. Now the first question you need to ask is, why is there a need for such a high fundraise? Ideally, bank should be able to fund its growth from the profit it generates, isn't it? But in case of IDFC First, it is aggressively growing with branch expansion, investing in technology, and its loan book is also growing at a fast rate. However, its ROE, that is return on equity, is low at around 10%. It means internal accruals aren't enough yet to fund aggressive growth without breaching capital adequacy norms. Hence, IDFC First has been diluting its equity year on year since the last 3 years to raise funds for growth. My concern is, when a company keeps diluting the equity, how does it create wealth for the investor? For that, let's first understand the basics. So, equity dilution happens when a company issues more share, thus reducing the ownership percentage of existing shareholder. For example, if a company has 100 crore shares outstanding and you own 1 crore share, you have 1% ownership. But if bank issues another 100 crore share, total become 200 crore and your ownership drops to 0.5%. Now you might ask, Sahil, I'm just a small investor, I don't own 1 or 2% share in the company. How does this equity dilution really matter to me? Well, it does matter because when equity gets diluted, your EPS, that is earning per share, reduces. For example, if the company earns profit of 1000 crore and there are 100 crore shares, EPS is 10 rupee per share. right? So if share doubles to 200 crore due to dilution, EPS drop to 5 rupee, unless profit also double. So you earn less profit on per share basis. Also, the bigger problem is IDFC First ROE at the moment is just around 10% and cost of equity is around 14-15% usually. Here cost of equity is basically the minimum return that investors expect for investing in stock given the risk. So think of it like a hurdle rate. If ROE is below this, shareholders may be losing value. So on one side, while this fundraise of 7,500 crore is positive for IDFC First, that shows the confidence of institutional investors. On another side, the concern is that even after 7 years since the merger of IDFC Limited with Capital First, IDFC First has to dilute its equity very frequently to sustain its growth momentum. And with further fundraise of 7,500 crore, its equity base would increase and hence its ROE would reduce. And its ROE is already low, unless the bank increase its profit at a faster rate. Although bank's MD Mr. Vaidyanathan is very confident of bank's growth in the future and has given strong guidance of increasing this ROE from December 23 levels of around 10% to 17-18% by FY29. In fact, bank has set ambitious target of 17 to 1800 branches for FY29 against 900 branches in December 23 and expecting net profit of 12 to 13,000 crore. But for bank to achieve these targets, it would have to expand its ROE to 17-18%, which is not going to be an easy task, especially after this continuous equity dilution. Now the fundamental question here is why IDFC First is struggling with low ROE of 10% when competitors like Federal Bank have ROE of 15% and AU Small Finance also has a similar market cap, enjoys 13-14% ROE. And the core reason is IDFC First strategy to focus on fast growth. To scale quickly, IDFC First Bank offered high interest on deposit. For instance, while top commercial bank offer an interest of 2.5% on saving account, IDFC First offers 7.25% interest rate on amount greater than 10 lakh. Even Federal Bank has less than 3% interest rate on deposit below 50 lakh. So as a customer for the IDFC First Bank, it's great. But as a shareholder, there are concerns. As a result, IDFC First cost of fund is on higher side. Now obviously when the cost of fund is high, bank has to offer loans at higher interest rate, and for that it has to expand in high interest product like microfinance and personal loan. Mind you, while microfinance and personal loan do generate high interest, they are unsecured loan with higher risk of default. And that's what happened recently with stress in microfinance segment that resulted in fall in earning for IDFC First. So earlier, IDFC First struggled from legacy infrastructure loan and now from stress in microfinance segment. Basically, rather than building a stable, low-cost deposit base and focus on unit economics, bank opted for speed. But this has resulted in asset quality related issues for the bank. Another reason for lower ROE is because bank is in aggressive growth phase and hence its OPEX, that is operating expenses, very high due to new branch opening, investment in technology and so on. And that has also impacted the ROE. Funny part is, on one side, bank is raising external capital for growth. On another side, it has declared dividend of 25 paisa per share. I mean, how can you give dividend when you are yourself struggling with earning growth and dependent upon external capital for growth? And this is beyond my understanding. So initial few years, I thought it's the difficult phase and IDFC First will eventually do well. And I trusted the leadership of Mr. Vaidyanathan. I'm still positive in his leadership, but now I am having some concern, especially after the asset quality issue and the continuous dilution of equity. So as a customer of IDFC First Bank for last 3-4 years, I am very happy with them. My experience has been very good. But as an investor, I have been waiting patiently for bank to improve its ROE. Because no company can grow forever by consistently diluting stake. It is just not sustainable. And with this fundraise, I have my concern around how bank will achieve its target of 17-18% ROE by FY29. So as far as valuations are concerned, there's a very good correction in the bank. Its price to book has also fallen significantly from highs of price to book of 2.5 to now at 1.3. And valuations are comfortable. I believe that bad news is already priced in. But ultimately, I would like to keep a close eye on how bank improve its profitability. Okay, let me not stress this video further. I just want to close this video by saying that it's been 7 years since formation of IDFC First and so far it has struggled to create wealth for its shareholder. Initial few years we could understand as it takes time to build a bank, especially when it inherited a weaker loan book and took time to clear it up. Also, COVID resulted in further pain. But now patience is getting over. The recent microfinance issue was unexpected and it only exposed the weakness in banks' credit underwriting and risk management process. At this point, I would give it a benefit of doubt. But now I would take any guidance from management with a pinch of salt. Can't trust the management blindly. As compared to IDFC First, I think Federal Bank is much better positioned in terms of asset quality. I like to call Federal Bank as Rahul Dravid of Indian banking. Slow and steady. And IDFC First has shown lot of promises similar to Prithvi Shaw, where people compared him with Sachin Tendulkar. But it didn't end well. I hope IDFC First really turns out to be Virat Kohli, who had his own set of struggles initially but later came out strongly. Also, there were discussions that IDFC First can be the next HDFC Bank. But I must say that IDFC First is nowhere close to HDFC standard in terms of credit underwriting. There's only one HDFC, just like only one Sachin Tendulkar. I just hope IDFC does not give further surprises in the near future. Valuation wise, there's a decent comfort, so I don't expect further downside. I think the worst has been priced in. In fact, its share price should do well if bank is able to grow its earning in FY26 as guided. So this is it for this video. I've tried to share all the latest development with honesty in the best of my knowledge. I hope this will help you make an informed investment decision. Now tell me in the comments, what do you think about IDFC First? Are you still keeping faith in the company's leadership or you don't find it promising anymore? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.